All right. Talk tickers time. Let's get into it today with another earnings call deep dive.
Love those.
Today we have JPMorgan Chase Q4 2024.
Oh, big bank earnings. Always fun.
Yeah. You know, these big banks, especially JPMorgan, they always seem to have some pretty interesting results no matter what's going on in the economy.
Yeah, and they actually give a really good overview snapshot of the whole economy because they touch so many different pieces of it.
Yeah, that's right.
Yeah.
And so, we've got the earnings call transcript. We've got some of the stock reports kind of breaking down all those numbers. And honestly...
Well, let's tease it a little bit, right?
Yeah.
Record revenue, record net income.
Again.
Yeah. So that's what we're going to be breaking down today. Is this sustainable?
Yeah.
What's going on there?
That's the big question, right? How long can this keep going?
Right.
So let's start out with just like a really high-level overview. So net income came in at $14 billion for the quarter.
That's a lot of billion.
There's a lot of billions.
Yeah.
That's huge. Earnings per share was $4.81.
Okay.
Revenue was $43.7 billion.
Huge.
And return on tangible common equity was 21%.
Mm-hmm.
So
like at a really high level, those are some really good numbers.
Oh, yeah.
But as you said, it's not just about the numbers. It's about what's driving those numbers and what it means for the future.
Yeah, exactly.
Yeah.
So let's kind of break it down now.
Yeah.
And start getting into some of the specifics. So let's start with net interest income.
Okay.
Or NII. Now, this is basically, the bread and butter of banking, right?
Yeah, it's the money that they make from interest on loans.
Yeah, exactly.
So this is where it gets a little interesting because when we look at NII, if you exclude the market segment, which is a little more volatile, NII actually went down a little bit.
Yeah, that's right.
It
was down, I think, like 1.5%.
Yeah, something like that.
For the quarter.
Yeah, and they're projecting NII, excluding markets, to be around $90 billion
for 2025. Yeah.
So why is that? Why is that happening? Lower interest rates and lower
deposits. Yeah.
Shrinking consumer deposits are putting a little pressure on that.
Yeah, and so that kind of raises the question of, okay, if their NII is potentially going down, shrinking, then how are they still hitting these
How are they
record revenues?
Getting these great numbers.
Yeah.
So this is where the non-interest revenue comes in. This is a big one.
Yeah.
So NIR, excluding markets, is up a huge 21%.
Yeah, that's amazing.
So that's where they're really diversifying their income streams.
Yeah.
Beyond just the traditional lending activities.
But let's break down what that non-interest revenue actually is.
Yeah.
So we're talking about things like asset management fees.
Right.
So that's where, people are paying JPMorgan to manage their money.
That's right.
Investment banking activities.
Oh, yeah.
So this is where they're helping companies, issue stock.
Right.
Do mergers and acquisitions, that kind of thing.
Right. They're facilitating those deals.
Yeah.
And that comes with some pretty hefty fees.
Right. Yeah.
So that's where that huge growth is coming from.
Yeah, so they're essentially building up these other sources of revenue to kind of offset
because
this potential shrinking of NII.
Yeah. The interest rate environment is definitely in question going forward.
Yeah.
So they're getting ahead of it and saying, okay, well, we can do other things. We can make money in other ways.
Yeah, that's smart. That's good planning.
Right, that's smart.
Yeah. So let's move on now to some of the individual business segments.
Yeah, let's dig in.
And kind of see how they're all performing.
Yeah.
So consumer and community banking, or CCB.
Right.
They saw some pretty impressive growth there.
Yeah. Record numbers of first-time investors coming into JPMorgan Chase.
Yeah. And what does that tell you? I mean, what was your take on that?
That's really interesting to me. I think that's an indicator of what's happening just in the market in general.
Yeah.
You've got people that maybe haven't invested before that are now coming in looking to put their money to work.
Right.
So that's a big sign.
It's a good sign for them.
Yeah, definitely.
Right. They also opened nearly 10 million new credit card accounts.
Huge.
That's massive growth in their customer base.
Yeah.
But on the flip side of that, average deposits are down.
Yeah, that's interesting. So you've got this kind of contrasting story.
Yeah.
People are eager to invest.
Yeah.
They're opening credit card accounts, but the average deposits are down.
Yeah, so what does that
So what does that signal
to you? What's going on there?
Well, it's a little puzzling. I think it probably signals a shift in consumer behavior a little bit. And it could be that spending is up, and so people are drawing down those deposits.
Right.
It could also be that they're looking for higher interest rates.
Yeah.
In other places. Maybe they're putting their money into savings products or other things that are a little more yield bearing.
Yeah, that makes sense. So it's a bit of a mixed bag there.
Yeah.
But overall, I think it's still pretty positive.
Yeah. I mean, 10 million new credit card accounts. That's huge growth.
Oh, massive.
So let's move on to corporate and investment banking.
Okay.
Or CIB. This is where the big boys play.
Right.
And they had record revenue.
Yeah.
Across the board. Markets, payments, security services.
Nothing's on fire.
Everything's on fire.
Yeah.
Investment banking fees jumped 49%.
Huge.
Massive jump. Putting them at the top of the league tables.
Yeah, so what's driving that? I mean, is it just...
Well, it's a combination of factors.
Yeah.
You got favorable market conditions.
Okay.
That's definitely playing a role. There's a lot of activity happening, a lot of deals getting done.
Yeah.
But it's also about JPMorgan's execution.
Right.
They're really good at what they do.
Yeah.
They've got the relationships. They've got the expertise.
Right.
And they're able to capitalize on those market opportunities.
Yeah.
So it's not just luck.
Right. It's skill.
It's skill. It's hard work.
Right.
And it's being in the right place at the right time.
Yeah. So they're not just riding the wave. They're
creating the wave.
Yeah.
In some cases.
Right.
But, with all this success comes challenges as well.
Right.
And one of the big ones that we're hearing a lot about is their capital position.
Okay.
Their CET1 ratio is 15.7%.
Okay. So that's, for those of you who don't know, that's a measure of a bank's financial strength.
Yeah. Basically how much capital they have.
Yes.
Relative to their assets.
Right.
And 15.7 is really high.
It's well above.
Yeah, it's well above regulatory requirements.
Yeah, the requirements.
Yeah.
So this is where it gets interesting.
Yeah.
Because you've got this massive amount of capital.
Yeah.
And the market's wondering.
What are they going to do with it?
What are they going to do with it?
Yeah.
Right?
Yeah.
Are they going to do share buybacks?
Right.
Are they going to increase dividends? Are they going to make acquisitions?
Yeah.
Are they going to just hold on to it?
Yeah.
So this is this is a really interesting dilemma.
What's Jamie Dimon's take?
Yeah, well, Jamie Dimon famously said, I've never thought of having cash in your pocket as a bad thing.
Yeah.
So
that's classic Jamie Dimon, right?
It is.
Yeah.
But it's not that simple, right?
Right.
You got to put that money to work.
Yeah.
You can't just sit on it forever.
Right.
So it'll be interesting to see how they deploy it. Okay, so let's move on now to what they're looking ahead to.
Yeah, what's their guidance?
What's their guidance for 2025?
What are they seeing coming down the pike?
So for 2025, they're expecting NII, excluding markets, to be around $90 billion.
Okay.
Yeah.
Now that's interesting because that might actually be a little bit lower.
A little bit lower than 2024.
Yeah. So again, this speaks to those potential rate cuts and the deposit trends that we talked about.
Yeah.
So they're seeing that as a potential headwind.
Okay. So that's something to keep an eye on.
Yeah, definitely.
They're also expecting credit card loan growth.
Okay.
To continue, but at a slower pace than in 2024.
Right. So still healthy growth.
Yeah.
But
more moderate.
Moderating a little bit.
Yeah. And then they're expecting expenses to climb to about $95 billion. And this is being driven by investments in technology marketing and, interestingly, hiring more bankers and advisors.
So they're investing in growth.
Yeah.
They're not cutting back.
Right.
They're saying, okay, we need to spend money to make money.
Right.
We need to invest in our future.
Yeah.
And that includes bringing in more talent.
Yeah. That's a good sign.
Yeah. And it's also a sign that they're maybe seeing some opportunities out there.
Right. And then finally, credit quality is expected to remain strong.
Okay.
With card charge-off rates holding steady.
That's good news.
Yeah. So that's...
that means it's
consumers are healthy.
Yeah.
The economy's relatively healthy.
Yeah. So overall, it's a
pretty positive picture.
It's a pretty positive picture, right? I mean, they've got some challenges.
Yeah. They've got some headwinds.
They also have a lot of strengths.
A lot of tailwinds. A lot of opportunities. Yeah. So it's going to be interesting to see how it all plays out.
Absolutely.
Yeah.
This is going to be a fun one to watch.
All right. So We've covered a lot of ground here.
We have.
We haven't talked about everything.
We've got one more segment.
Yeah, we still need to talk about asset and wealth management.
Right.
Or AWA.
Right, AWM.
So we'll get into that in just a minute. But first, let's take a quick break.
Okay.
And we'll be right back. All right, so we're back, and we're talking JPMorgan Chase Q4 2024 earnings.
Yep. Still breaking it down.
Still breaking it down. We've gone through a lot of the numbers here.
Right.
But let's kind of bring it back to our listeners for a second. Why should they care about any of this?
Right, because at the end of the day, what does JPMorgan Chase's performance have to do with the average person?
With me, right. Yeah.
Right.
Yeah.
Well, I think it's important to remember that JPMorgan Chase is a bellwether for the economy as a whole. They're so big, they touch so many different pieces of it that their performance is often a reflection of what's happening in the broader economy.
Yeah, they're kind of like a canary in a coal mine.
Exactly. So if they're doing well, it's generally a good sign for the economy.
Yeah. And if they're seeing challenges, then that might be a sign that there are challenges on the horizon for the rest of us.
For the rest of us.
Yeah.
So it's not just about, their stock price or their earnings per share. Yeah. It's about
what those numbers tell us.
Tell us about
the future.
Yeah, the direction of the economy.
Right. Exactly. So
for example, they're expecting credit card loan growth to slow down a bit in 2025.
Okay.
Still healthy growth, but not as rapid as it was in 2024.
Yeah.
So that could be a sign that consumer spending is starting to ease up a little bit.
All right, so that's something to watch.
Yeah, definitely something to keep an eye on.
Yeah.
And then we talked about those shrinking consumer deposits.
Right.
Right. So that's another piece of the puzzle
that
kind of suggests that maybe consumers are a little bit more cautious right now.
Okay, interesting.
So those are just a couple of examples of how JPMorgan Chase's performance can give us insights into the broader economy.
Yeah, no, that's a really good point.
Yeah.
So all right, let's move on now.
Okay.
We've talked about a lot of the kind of the core business segments.
Right.
But we haven't really gotten into asset and wealth management.
Oh, AWM.
Oh, AWM.
The money maker. So this is where they're managing trillions of dollars.
Trillions, yeah.
For individuals and institutions.
Yeah.
And this segment is booming.
It is. It's doing really well.
Really well.
Yeah.
They had record inflows of $234 billion.
Yeah, that's massive.
From long-term investors.
Yeah. And their assets under management, or AUM, is now over $4 trillion.
Huge.
That's just an insane number.
That's a lot of money.
It is, yeah.
So what's driving this growth?
Yeah, what's going on there?
Well, I think it's a few things.
Yeah.
First of all, JPMorgan Chase has a really strong reputation for financial management. They're seen as a safe pair of hands.
Right. Especially
in times of uncertainty.
Right.
They've also been really good at expanding their AWM offerings.
Okay.
So they're catering to a wider range of investors.
Right.
They've got everything from traditional investment products to more specialized alternative investments.
Okay.
So they're really kind of...
Yeah, they're kind of a one-stop shop.
A one-stop shop for all your wealth management needs.
Right.
And I think that's really appealing to a lot of investors.
Especially in this environment where people are looking for...
Where people are looking for stability.
Yeah, stability and trust.
And trust. Yeah. They want to know that their money is in good hands.
Right, right.
So
AWM is...
AWM is a
bright spot.
Yeah, a bright spot for JPMorgan.
For JPMorgan Chase.
Yeah.
It's a growing part of their business.
Yeah, and it seems like it's only going to get bigger.
Yeah, and it's a high margin business.
Right.
So it's very profitable for them.
Yeah. So that's that's good for JPMorgan and it's good for their investors. So.
Yeah. So overall, JPMorgan Chase is firing on all cylinders.
Yeah, they're
doing really well.
Really well.
But as we said before, there are some challenges on the horizon. Yeah. So it's going to be really interesting to see how they navigate
those challenges.
But I
think they're well positioned to do so.
Yeah. They've got a lot of strengths.
They do. A lot of
life.
resources. Yeah.
They've got a great management team.
Yeah.
They've got a diversified business model.
Right.
So I think...
So they're in good shape.
Yeah, they're in pretty good shape.
Yeah.
All right, so we're going to take another quick break.
Okay.
And when we come back, we're going to get into the This Is Not Financial Advice segment, where we're going to come up with some
crazy
ideas. Trade ideas based on all this information that we've gleaned from this earnings call.
Yeah, because why not?
Why not?
We're here to have fun.
Exactly. All right, so stick around.
We'll be right back.
We'll be right back. All right, we are back with our This Is Not Financial Advice segment.
This is my favorite part.
Where we're going to come up with an absolutely outrageous but plausible trade idea.
Yes.
Based on everything we've learned.
Based on the earnings call.
From this earnings call transcript.
We are not financial professionals?
Yeah, we're not giving you financial advice.
Please do not take this as financial advice.
Yeah, this is purely for entertainment.
Purely hypothetical.
Hypothetical. And just to kind of get your brain thinking in new ways.
Yeah, think outside the box.
Outside the box, yeah. So, I've been thinking about this.
Okay.
And you know, one of the things that really stood out to me was this whole capital position thing, right?
Right. 15.7% CET1 ratio.
They've got so much cash.
They do.
Just sitting there.
Mountains of it.
Mountains of it, right.
Yeah.
And they're talking about, you know, investing in growth and all these different things. But what if they did something completely unexpected?
Okay.
What if they went...
I like where this is going.
I'm just spitballing here.
Yeah.
But what if they went full on...
Full on what?
ESG and launched a subsidiary that was dedicated to carbon capture technology.
Okay.
Hear me out here.
I'm listening.
So they've got all this cash right. They could use that to invest in developing cutting-edge carbon capture technology. They could partner with like some of these
huge
climate tech startups that are out there. And really like
be a leader.
Be a leader in this space.
In that space.
Right.
Yeah.
And it would be
a win-win.
It's a good PR move too.
Huge PR win.
Right.
They could
like very trendy.
Yeah, it's super trendy.
Very on brand right now.
That could attract all these like you know, ESG focused investors.
All the ESG funds would be piling in.
They'd be like the darlings of Wall Street.
Right.
Right.
It's like printing money.
It's like printing money and they're actually doing something good for the planet. Yeah, you're saving the world.
Saving the world, making money.
And making tons of money. Love.
I mean, it's a little out there.
It's a little out there.
But it's not impossible.
It's not impossible.
I mean, stranger things have happened.
Stranger things have happened.
Yeah.
And they've got the resources to do it. They've got the brand recognition.
They've got the brand.
They've got the reach.
The reach.
I mean, it's
talent.
It's a long shot.
Expertise.
It's not crazy.
It's not totally crazy.
Right.
Right.
It could happen.
It could happen.
So...
All right, so that's our outrageous
but plausible
trade idea.
Trade idea. Okay. JPMorgan Chase carbon capture technology subsidiary.
Boom.
IPO in 2026.
IPO in 2026. Get in on the ground floor.
Yeah, early investors.
All right, so
disclaimer.
Disclaimer. This is not financial advice.
Please do your own research.
Do your own research.
Consult with a financial professional.
Yeah.
Just don't listen to two yahoos on a podcast.
Yeah, don't listen to us.
Yeah.
All right, so...
But it's fun to think about.
It is fun to think about.
Yeah.
And I think it just kind of highlights the possibilities that are out there.
The possibilities are endless.
Right.
When you have that much capital.
When you have that much cash.
Yeah.
You can really do anything.
The world is your oyster.
The world is your oyster.
Yeah.
All right. So that's going to do it for us today.
That's it for this deep dive.
Thanks for joining us on this deep dive into
JPMorgan Chase.
JPMorgan Chase Q4 2024 earnings.
It was a good one.
Yeah, it was a good one.
Always a fun time.
Always a fun time talking big bank earnings.
Absolutely.
So be sure to tune in next time.
Yeah.
For another exciting episode
of Talk Tickers.
Talk Tickers, where we break
down
all the latest numbers and give you our outrageous
but plausible trade ideas.
Yeah.
All
right, until next time.
Happy investing.
Happy investing.